All right, what's up, team? It's Ruben from TGE, and I want to discuss about the trade that I actually lost it. Why I took calls. I actually was a little bit more towards the bullish side this morning, but ended up flipping down on me. And so I want to go over the trade real quick. If you take a look at these key levels that I have 480, 475. You see the DEM lines. That's the daily expected move for the Qs. 481 to 68, and then also 469.70 or 469.51 with a max pin of 470. So these are all levels being picked up from over here by Gextron. And if I click on this little button right here, the calendar button, you'll see all the available expirations. And I like to get these levels either like pre-market or the first before the first 30 minutes of the market to get the highest probability. And right now you can see that you'll see the expiration, you'll see how many days are left, and then you'll see EM, the EM column, which stands for expected move for that given expiration. And so we took I took a long position on QQQ, okay, around this bounce right here, this green candlestick. And so at the time, I was like, okay, we're pretty much by the max pain. We are um, we're over here like by the near the daily expected move, and then we took it all the way to the upside for a 24% return. It actually hit 24% return the first trade, and then it got rejected. The next thing that I was looking at when price was going back up was like, okay, can it hold this key level 475? And for for a few minutes it did, but then it got rejected really, really hard at the 15-minute time frame. And you can see here that it tried to get tested again on this following red candlestick, and then it got rejected all the way back down. And so I alerted the team. I said, hey, we're going to have a break even stop loss on this trade. And that ended up happening, right? It hit 24%, and then it took the break even stop loss. What I really wanted to aim for was like near the daily expected bottom move and take it all the way to the daily expected top move, which is 481. That would have been a great trade, in my opinion. This would have been about maybe like a anywhere from a 60 to 80% return on the trade. But there are these key levels to pay attention to, which is like the 475, the 480. These are strong key levels, and 475 proved itself to be a strong key level area. And so it got rejected. I got stopped out, and then we were right here. Okay, this is where the failing QQQ trade came into play. I think it was a 20% stop loss. It stopped around here, and then we're like, okay, we're going to try this again for QQQ longs and try to aim for again the daily expected top. In my head, I'm like, okay, we are near the bottom. We're near heavy support area, which is this max pain area. Let's see if we could take it for a reversal. And so it ended up failing. This one was a tight stop loss, especially because it was a 1 DTE. So I ended up just getting stopped out at 20% loss, and that was it. Okay. And as you can see here, what I want to show you here is one, a few key takeaways is like one, when you're trading these short-term expirations, anything less than a year, honestly, you really should need to have a tight stop loss because these intraday movement patterns will hurt your account. And once you start being profitable, you need to start setting trailing stop losses so your contract doesn't go from green to red, right? That sucks when it happens. I like personally like a 20% P&L on the trade. Then I'm going to start setting a break even and a trailing stop loss, just so at least I can kind of I don't lose all the capital, right? You don't want to like go back from green to red, essentially. And the other thing to note here is that when you're looking at, I had a conversation with a trader yesterday, and a lot of traders believe in the RSI and the MACD. We can be very, very red are very undersold or whatever the MACD says or the RSI, and we can go lower. Okay, a better indicator whether we've hit a top or a bottom for that day or for the week is just really using the expected move formula, which again, you can do this yourself. Okay, the basic formula is um, it's the ask price of the at the money call and the at the money ask price for the put. Add them together for that given expiration date, and then you got an expected move. Okay, and that's the formula for that. Gextron's formula is a little bit tweaked to include the Black-Scholes model, and so that's that, right? So, but even then, by using this formula, then you have realistic expectation, real price targets for that given expiration date, rather than using the MACD or the RSI. Like that stuff is lagging indicator. You know, you want to be using implied volatility and the current the option pricing to be able to forecast the potential move either to the top or to the bottom, right? And so this is what I wanted to showcase really is that using the expected move, whether you want to do it yourself or use Gextron to do that, is really important. And then also just keep an eye out for key levels. Yes, we could have taken profit here, but I was aiming for the daily expected top move, but it ended up not working out, and that's okay, right? It happens. The goal is here to keep tight or small losses but bigger wins, and so that's all I wanted to show you for this QQQ trade. Didn't work out as expected, but all right, there'll be another one, right? All right, I'll see you guys on the next one.